Hello and welcome to CMC Markets Weekly Trading Outlook for the week of January the 5th, 2015. Happy New Year. My name is Colin Szynski, Chief Market Strategist. Our topic this week is New Year's rally hinges on payrolls. And what that means is that for the last couple of weeks, we're coming off what was a really nice Santa Claus Rally. We had a good bump in U.S. markets middle of December, and they've managed to pretty much hold on to those gains through the latter part of December. Also through December, we saw some significant catch-up rallies in a number of markets around the world, including Germany and the UK and Canada and others. But as we move into the new year, we are starting to see a little bit of signs of sluggishness. The manufacturing purchasing managers numbers for December came out on Friday, January the 2nd, and they were mixed to a bit soft. So we saw particularly we had the UK and the US numbers disappointed, and that's a bit of a concern because those had been two of the stronger economies around the world. So as we're moving into January, we're starting to see markets tumbling back a little bit. As I'm speaking, the U.S. is, the Dow, for example, has started out strong on January the 2nd, and it's already tumbled back into negative territory. We're also seeing some weakness in the pound today and continued weakness in crude oil as we start off the new year. So as we move into the first full week of trading for the year rather than just a single day, we're really seeing a focus this week on payrolls. And the reason for that is, as I said, some of the purchasing managers' numbers have already come out. We do get service numbers at the early part of the week, but really the key focus of the week is on the U.S. non-farm payrolls, Canadian jobs, and German employment, which come out over the course of the week. We also have the ADP payrolls for the U.S. coming out on Wednesday that also could have a significant impact on trading through the week. In a lot of ways, this is a prelude to the following week because the one big central bank decision we have coming in January is the ECB, and they've put their meeting off a week. So while the Bank of England meets on Thursday, the ECB doesn't have their meeting till the following Thursday. To start off the new year, ECB President Draghi has said that they do have some concerns about price stability, and that they are working on more monetary measures to deal with the potential issues and disruptions that are facing them. So we could see in a lot of ways, some of the stuff that we will see happening this week could be also viewed as preparation for the following week, and people looking at it through the prism of not only what does certain news, say U.S. news, mean for the Fed, but what does European news mean for the ECB. And so as we move through the week, we may see that. Just to note, most of the focus this week is on economics data. There isn't much in the way of corporate earnings news coming out this week. Earnings season kicks off next week. So this week, really, we do have a prime focus mainly on the jobs numbers that are coming out throughout the week. I wanted to start by highlighting some interesting things we'd seen in client sentiment as we've moved into the end of the month. We are seeing some interesting divergences here that I wanted to highlight. The first one is in currency markets, where we've seen the pound and the euro weaken recently. However, the attitudes towards the two currencies are very different. As we can see here on the pound, we have clients are very strongly net long, and in fact on Friday, even though the pound is sold off because of the soft UK purchasing managers report, we're actually seeing clients have been going long into this. We've got a big jump in long positions in sterling in cable on Friday, January the 2nd here. So that means that clients have been looking at this dip as a potential opportunity. On the other hand, clients remain quite bearish on the euro. The euro has been, we're still seeing top clients 93% sell in terms of position value, and 65% bearish in terms of numbers. So we are seeing some clients taking some fairly large bearish positions against the euro still in place. People are still concerned about what President Draghi may do, what kind of new measures, new QE could be coming down the pipe from the ECB in the coming weeks. The next one, though, we also see this showing up in stock markets. Interestingly enough, there's an interesting divergence here as well, where we're actually seeing the the U.S. markets, which had a pretty good run, but have been starting to soften and roll over a little bit, and we're seeing clients are pretty short on that. We have all clients 75% short in terms of position value, top clients 65% short. However, on the DAX, on the Germany 30, we're seeing that in fact clients are net long, and still, and we've seen this actually widen on Friday. Clients have in Germany have been towards Germany have been kicking off the year by increasing long positions. So people do seem to be bullish on that, and I guess that's part of the hope that new monetary stimulus from the ECB will help to boost the German economy and the Eurozone economy in general. So that's an intriguing development here to be keeping an eye on. Might be more bullishness towards Germany, but we'll see, right? Because if the reason that the ECB has to crank things up is because the economy is going off the rails, or there's more political risk and more financial risk, there's a Greek election campaign underway where Syriza might win, and that could upset the apple cart, and so on. That in fact this could be a short-lived. A short-lived move here, or a short-lived swing upward in sentiment, depending on what happens over the next few weeks. The final one here I just wanted to highlight was in the energy markets. We do have, even though we're still seeing WTI and Brent continue to weaken here, we are seeing them getting close to 50 and 55, 50 for WTI, 55 for Brent. They've been trying to settle out, but at the same time, have they settled out, or is this a pause in a bigger downtrend? We actually have some clients right now on Brent. Top clients are 70% long and 76% long for all clients. This is a bit of a change from where we were a few weeks ago, where clients were net short on oil. So it does seem as though people are trying to do some bottom fishing here and bargain hunting. It remains to be seen, though, if an actual floor is in place, or if this is just a pause in a wider downtrend. The intriguing one is natural gas, where it seems as though people are quite unsure about what to do. We have, in terms of number of clients, particularly top clients are actually short natural gas. But in position value, we actually have clients are long natural gas, which suggests you've got a large number of small short positions and a smaller number of large long positions. Natural gas has been hit pretty hard in the last few weeks. We had a very warm December here in the east, so natural gas demand has been lower. Temperatures have started to fall into January. The question is, though, is the cold snap we're starting to get too little too late, or will it be enough to salvage home heating season? At a minimum, it does seem as though we may not have so far we have not had as severe a winter as we had last year. However, we still have two or three more months of winter to go. So, as we all know, anything can happen. But there is when you do get this kind of confusion, you could be at a turning point for natural gas. So keep an eye on that. It may remain volatile right through the winter in the northern hemisphere, of course. I wanted to just highlight some action in indices as well, and something interesting that's happening here. I'm just going to highlight the S&P for a moment versus the DAX. I'm going to put both of them up, and then I'll look at both of them individually, which is something we've seen. We did get a Santa Claus Rally this year in December, but what's intriguing here is that the U.S. markets, the Dow and the S&P and the Nasdaq, did manage to get to new highs in December before they started to roll over. On the other hand, though, if we look down here, there was a negative divergence here, but more importantly, we're not getting confirmation from other markets. The U.S. markets hit new highs, but not a lot of other people did. The DAX, for example, peaked at a significantly lower high. And I'll show in a couple of minutes that there were a number of other indices that are actually peaking at lower highs. So this U.S. rally has been getting narrower and narrower and narrower, and the breadth continues to get narrower and narrower, which remains a big concern. So I'll start here with highlighting the what's going on with the S&P. And here we can see we did get a new high in late December. However, we're seeing lower highs kicking in still on the RSI. And what is that? That's a negative divergence, tells you upward momentum is slowing. RSI is down at the 50 line. If it breaks that, would confirm another downturn in momentum. We could get a downswing in it. So we topped out here just short of 2100. We're back around 2050. This 50-day moving average here is at about 2040. There's the 2000 round number. And down here, this previous low was in and around 1975. If we pull up the DAX here, the Germany 30, we'll see that we actually, interesting enough, their big run was in early December where they did touch a new high here above 10,000, nearly 10,100. Big sell-off. On the rebound, we're getting a lower high. So what does this suggest? It suggests the dominance in the market is starting to shift from bulls to bears. The bulls didn't have enough oomph to really push it up through and take another run at this. Suggests it's all starting to run out of gas. And what are we seeing? This here is RSI peaking at a lower high. Again, suggests, and short of 60, by the way. This is important. When you do get an RSI peaking short of 60, it suggests that you might be into a bearish market. Also, if we take a look here, there's a left shoulder, there's a head, and there's a right shoulder in the RSI for the DAX, and that's significant. Whenever you do get patterns show up in things like RSIs and MACDs, they're rare, but when they do happen, they're quite powerful, and you need to pay attention to them as a trader. I'll just highlight a couple of other indices here briefly. The UK 100 is in fact is one that really peaked through the summer, had a little double top here back in September, saw for outlook, and now you've had in the last two market rebounds, the one from October to early December and the Santa Claus Rally. Look at this, lower highs, lower high and lower high again, and in fact here we've got lower high here on the RSI and lower high again on the RSI, and it's back under 50 and rolling over. So things are not looking too good for the FTSE here right now. You can maybe make the case that you're into a 6100 to say 6750, 6800, 6700 trading channel, but you're starting to weaken within that again. Your first support, there's a 6500 round number, 6400 we've seen a couple of supports, and then this set here of candle bottoms is in around 6175. So there is room for a correction in the FTSE if we don't get some reason for support, and also we'll just highlight a couple of the resource markets here very briefly. Canada looking actually quite similar to the FTSE, followed the two big sell-offs in the market of early October, early December, and both times on the rebounds peaked out at lower highs. Canada, of course, it does get impacted by the energy sector, is a big weighting, as well as the mining sector, and both of those could be dragging. Finally, we'll finish with the Australia 200. Which is similar to, again, to the UK and Canada double top. And by the way, the UK, to note, of course, has a higher weighting in energy than a number of other indices. So it's a large cap market, but it does have a little more of a resource weighting. So that could be it's trading more as a resource market in some ways for the UK. So double top. Again, both of the big rallies topped out at lower highs here. This is 5,500 resistance for the Aussie. Initial support in here around 52.85. This is 5,200, and this big double bottom here is closer to 5,100, 5,150. Now we'll move over. I've talked a little bit about some of the weakness we've seen in resource-related indices. We'll talk now briefly about resources. We'll start with crude oil, and we'll bring up both WTI, and I'll bring up Brent here to speak to both of them briefly. Basically, in both cases, the indices have been trying to level off here around 55. The WTI tried to level off around 55. That's kind of failed, and it's drifting down. I would not be surprised to see it end up under 50 at some point, and possibly lower. The 2008 low for WTI was around $35. It may not get that far in the near term, but there is still room for some downside. One thing we are seeing, though, is hugely oversold for WTI and a bit of a reverse head and shoulders base kind of trying to form here. So if you did get a pop, the first resistance around 55.50, these candles here around 57.75, and the $60 round number. So downside probably a little under 50, upside maybe up to the high 50s for WTI over the next week or so. Similarly, looking at Brent here, Brent tried to stabilize around 60. It's drifted down here to around 57, testing in and around, still holding 55 for now. Could dip below 55, maybe even test 50 at some point. Again, there's a reverse head and shoulders bottom trying to form here in the RSI, and it's getting pretty oversold. But as we've seen, it's been oversold for months, and it just keeps falling. It could stay oversold for a while. If you did get a pop, the $60 round number could emerge as initial psychological resistance, followed by this is in at around 62.75. We see a number of shadow tops here. The other commodity market I wanted to highlight is natural gas, which I spoke to briefly earlier. We've got here actually trying to pop a bit here today. It's gotten a little oversold. Temperatures have fallen. We've gotten a bit of a cold snap. If winter does arrive in a meaningful way, we could still get a seasonal rally out of natural gas. First resistance in around $3.15. The bottom of this gap is about $3.32. The top of this gap is about $3.44. So you could see it try to fill in this gap if you do get a seasonal rebound on falling temperatures. And it does look as though it's kind of trying to stage a bit of a breakout here. Just wanted to talk briefly to gold, which here is gold is actually been acting reasonably well. The U.S. dollar has been continuing to strengthen, but even with the U.S. dollar strengthening and the U.S. dollar index getting above 90, gold has stabilized here above 1175. First resistance around 1200, and then up at around 1230. So but gold does appear to be leveling off. It's moved up above its previous lows, and it is getting some support here. If the ECB does get serious about ramping up its balance sheet, in the past that's been positive for gold. And it could be a gain if we do follow that. Gold has over the longer term been tracking the ECB's monetary policy more closely than that in the United States. So important over the last 5 years or so. So it's important to note that gold does appear to be leveling stable here in and around say $20-$30 of 1,200 on either side at the moment. And just wanted to wrap up with a couple of currency market comments. Specifically, I wanted to show the pound because, as I noted earlier, the pound is actually breaking down today. It's taken out the $1.55. It's been in a bear market since the beginning of July. Look at this. Each time the RSI gets up close to 50, and boom, it rolls over. This just consistently said you're in a downtrend here. You're rolling over again. Downward momentum accelerating. You're not oversold yet. You've broken through 155. This was the bottom of a 155 to 158 channel. Even if you use this previous high 156.25, that takes you down to 153.75, or about where you are today from this narrower range. This bigger range measures you down closer to 152, and you certainly cannot roll out the 150 round number, which is a big psychological hurdle that's looming closely along the way. So, and of course, we are seeing this is a combination of things where perhaps there with the UK this year, you've got its exposure to Europe. You've also got softer PMI. So, if you do see some softness in the UK, this seems to be reflecting it currently. I'll also note take a look here at the euro dollar. And it's also broken down today. It's taken at 121. Concern is obviously that the ECB could come up with some sort of meaningful quantitative easing or some other kind of more aggressive monetary stimulus program than it's been doing to date. It's testing that 120 round number right now. The previous channel it had been in was about 125.75 down to about 122.75. So that's about 3 cents. Could take you down to about 119.75, or just in here at around this 120 round number barrier. So you are getting to a point where maybe you might start to see some support for the euro, but as we've seen, it's been in a downtrend for a long time. Even if you did get a bounce, probably more of a pause within a bigger downtrend. 121 may emerge as new resistance. Again, every time this thing peaks up above 50, it turns around and gets smacked back down. It has gotten a little oversold here. You do have a positive divergence on the RSI forming. It's a little early though. I mean, this could get more oversold. It's hard to say at this point with the euro, but certainly the one thing we can be sure of is that it's likely to remain active off of all the European data throughout the week, and any comments that coming out of Europe as people look ahead to the ECB meeting being held later this month. The final thing I just wanted to take a peek at, I'll do Aussie dollar and dollar yen. So let's just take a peek here at Aussie dollar. Aussie dollar has been trying to level off here in this 81 to 82 and change range. It does seem to be trying to form a base here. If this fails, you can't rule out a retest of the 80-cent level, particularly since RBA Governor Stevens suggested that he'd be more comfortable seeing it in and around 75 cents. So this could still be a pause in a bigger downtrend. It's too early to call a bottom on this. It's going sideways, but if you did get a breakout 83, breakdown 80, and perhaps lower on the Aussie dollar. On CAD dollar, I'll just bring that up briefly. And CAD dollar, we're seeing breakdown again. This is with crude oil prices breaking down, so it's testing 85 cents. And if it does take that out, you had a measure here of 85.65 to say 86.65, puts you 84.65. So you're starting to get close to oversold for CAD dollar, but as long as if oil remains under pressure, then this may remain under pressure as well. The final one I wanted to take a quick peek at is dollar yen, and which has remained quite active. So, huge run for dollar yen, but it did not in this last rally, is running into resistance at a lower high near 120.75, previous high near 121.80, closer to 122. We're seeing the RSI starting to roll over at a lower high, does suggest the upward momentum might be starting to slow. It looks like we're basically going into some kind of consolidation channel here between, say, 116 and 122, and we could see it bounce around sideways for a while, but even range-bound trading can create opportunities for active traders. So as we move into this first full trading week of the new year, we are seeing that the big question is: are we going to get to see the New Year's rally pick up where the Santa Claus Rally left off and see markets continue to advance, or are they exhausted and we could see them start to roll over here? And the key data we're watching for this week is primarily the employment numbers, so which come out from the U.S. and Canada. U.S. is on Wednesday and Friday, Germany is midweek, and Canada is on Friday. So those numbers could be particularly significant in terms of market sentiment. Also, obviously, trends in the crude oil price may also remain active, and how people are looking toward the following week's ECB meeting, and if people are setting up for earnings. So there's a lot going on, and it looks like it could be an active week for trading.